So I'm going to do the market update just a little bit different because there's not much that has changed. It's just volatile, right? And so I'm going to teach you a little bit what to look out for in the news. So what I notice anytime I see someone presenting, I see that everybody stares blankly. And no one takes notes, no one actually learns anything. So if you guys take notes and you learn something and you text me said notes, I will send you either a $5 Amazon gift card or a $5 Starbucks gift card. I'll buy you coffee just for taking notes and learning a little bit. Trying to be nice, trying to make y'all learn just a little bit. Okay. So what gives me the right, how can I be an advisor? Like, how can I speak on the market at all? I've got a bachelor's and master's in economics. I've been in this mortgage industry for 23 years. I've done competition case studies with universities all around mortgage rates. My son went to UCLA just recently, got his bachelor's degree, and did a case study with the Federal Reserve that he actually won. And I got to mentor him on it. It was all around mortgage rates. So when I say that I got to advise the Federal Reserve, I put ish because I advised my son who got to advise Jerome Powell and all the voting board members. He got to meet him and all that good stuff, and I got the selfie of him meeting it. So I've been very much on kind of the leading research edge of how mortgage rates work. And I've been doing this for upwards of 20 years of my life. So it's something that why it pertains to you, it doesn't always matter why it pertains to you, but you should understand some of the basics to what to look out for. Now, what are some news sources? And I'll actually type it in here. What are some news sources that you guys typically get your news from? Instagram. IG, fair.
You and Instagram sometimes?
Yeah, what'd you say? Me? Oh yeah, sometimes. Where else do you guys get your either real estate updates? Like I know Sarah Ayala, she's the first one I saw on IG this morning, was talking about there's like, what, 284 homes listed in Riverside or something like that? I don't know if it's true. Where else do you guys get your information from?
The internet. Podcast.
Well, specifics. Like MSNBC could be one of them. Yahoo Finance could be another. Like. Okay. How often are you on Keeping Current Matters? All right, ladies, what about you on Zoom? Where are you guys getting your news from? Alvaro. Y'all are scaring me now.
Social media. It's just social media.
So mostly social media. Okay.
PCM and podcasts.
What'd you say, Renee?
PCM, Keeping Current Matters.
Yeah, okay. And podcasts, okay. All right, does anybody go on Yahoo Finance? Is anybody going on any Apple Finance, any financial news sources whatsoever?
No.
Rock on, okay. So, I know that everybody originally saw, and so many people said on Instagram, oh, rates are gonna cut 6 times this year. Oh my God, we predict 6 interest rate cuts. The Federal Reserve is gonna keep on cutting. It's gonna be a great year. Does anybody have an idea of why that didn't take place?
No.
Okay.
Job growth.
Yeah, we're on the right track. So first of all, how influential, when you hear rate cuts on the news, how influential do you think it is for mortgage rates? How influential do you think it is for your business? Okay, so what most people don't know is prime rate. When the Federal Reserve says they're going to cut short-term lending, it actually doesn't have anything to do with mortgage rates. It just has to do with the investor sentiment around mortgage rates. So prime rate is bank-to-bank lending. And so if our market, and our market is a bond, it trades daily, literally it swings up, oh, look, there you are. It's okay, we figured everything out without you.
Awesome.
Yeah. So when our market swings up and down, it swings daily. We could, in one day, go a whole percentage point up or down based on the news out there. So I'm going to give you some markers just to look out for. Does anybody know who this guy is? Yes. So he is the chairman of the Federal Reserve. These people, there's 12 voting members on the Federal Reserve. They could tweet something. I've seen it happen. They could tweet something negatively or something saying that, they're worried about the economy and your interest rates will go up 0.25% that very day. So if you have pre-approved buyers, and they're at their max, they just killed purchasing power by one singular tweet. So understanding how interest rates, mortgage rates work is imperative, since we're all scraping the barrel, is what I call it, on the buyers that we have. Meaning most of our buyers make $80,000 to $100,000 a year, and we're putting them into $5,000 mortgage payments. They barely qualify. We are well far and above where normal budgetary means are. So this impacts, and you guys have to understand just a little bit of this, this impacts our day-to-day client emotions, because in one Twitter stroke, I can take someone that says, hey, they're pre-approved for $450,000. Just kidding, today they're only pre-approved for $400,000. And I just emotionally wiped out your client from top to bottom. So understanding just the basics of how these voting members and how Jerome Powell, what they do and how they influence investors, not mortgage rates, but investors, which influence. So the Federal Reserve is meeting this month. It is hedging right now based on some economic reports that we're going to talk about, that they're not going to reduce bank-to-bank lending. There will be no change whatsoever to mortgage rates based on that news, because it's already priced into the market. Right now, mortgage investors are hedging that they're not actually going to change prime rate until June. That's what the main hedge is. So again, prime rate doesn't matter. It doesn't matter if the Federal Reserve raises rates or they cut rates. It matters the sentiment of the investors. Because you could, just like you can invest in Apple right now, you could be an investor in mortgage-backed securities and sway how mortgage rates work if there was a bunch of us doing it at the same time. So there's a couple of things to look out for, and I could, with 100% accuracy, predict mortgage rates if I could predict 2 economic reports. What was one of them? You said one of them. CPI. CPI. Yeah, inflation. Anybody else? So the Federal Reserve has 2 jobs, and these 2 jobs are what influence mortgage rates. So they have to have price stability, defined by 2% inflation, and they have to have maximum employment, which doesn't mean, I put unemployment, it should be employment. Maximum employment doesn't mean 0% unemployment. It actually means a 4.5% unemployment rate. So when the jobs reports comes out, when it shows job creation is double that what's expected, that came out at the beginning of February. And guess what our rates did when we saw good unemployment numbers? Went up. Yeah, interest rates went up. So I don't need you paying attention to, oh my God, the Federal Reserve is going to cut rates 6 times this year. I don't give a shit. What I want you paying attention to is I want you paying attention to job creation. I want you paying attention to unemployment rate. I want you paying attention to anything with the word inflation, because we need to see unemployment rates go up before mortgage rates will come down. And I'm going to explain why. So the whole point of the Federal Reserve raising prime rate is they're trying to force savings as a part of it right now. So your savings accounts, 4.5%, 5%, it's beautiful. They want people to stop spending. If people stop spending, then it's going to put pressure on corporations. And if corporations are losing money, what's the first thing that they're going to cut? Employment. They're going to cut people. So in order for inflation to go down, in order for the demand of goods to be over the supply, then we have to see literally corporations feel the squeeze, and then that squeeze to be put on the American families by unemployment going up. So again, 2 jobs, 2% inflation that the Federal Reserve has, and 4.5% unemployment is right around the measure. Right now, we're tracking about 3.9 inflation. The next date the CPI is coming out is March 12th. And we're also tracking 3.7% unemployment. This week, 3/8 is a market mover economic report that's coming out. It's coming out 8:30 Eastern time. And if I see that job creation is double, I have to go through my whole pipeline that day. because that's going to be showing that inflation is sticky, that the Federal Reserve, that investors are so weary, that there's so much crap going on in the economy, so much uncertainty, that they're not going to want to stay invested in mortgage-backed securities, where a riskier bond, they're going to move it over to something safer like the 10-year Treasury. So we need more people to invest in mortgage-backed securities, and we have to see less and less uncertainty by making sure the Federal Reserve is doing their jobs. So does everybody understand that when you call to tell me, oh my God, rates are going to go down 6 times this year, I'm going to laugh at you because I told you to take notes and listen to me. That has nothing to do with mortgage rates. Mortgage rates has to do with investor sentiment. And investor sentiment all has to do with the uncertainty in the economy, which is stationed primarily, not fully, around inflation and unemployment.
So sentiment.
No, I would say if you're going to invest in anything, I would say stick with the S&P 500 or do the QQQ or the Magnificent Seven or something like that. No, you don't have to play with mortgage-backed security market. Now, you guys can follow the 10-year Treasury. So what do you pay attention to? Unemployment rate, CPI, PCE, anything with inflation in it whatsoever. I can give you the dates. Like, it is literally the beginning, the first week of every single month is when unemployment comes out. So March 8th, April 5th, May 3rd, the beginning every single month. Just know that any lender that you have is going to, it's like a heart rate monitor, our rates right now. So any lender that you have, we all brace for it. We're all up super early. We're all looking to see how the market is hedging at that time too, to see how it's going to impact our clients. And I'll show you a little bit of how it impacts clients. Same thing with the consumer price index. It comes out the same week. It's right around the 10th. So we've got the March 12th, April 10th, May 15th, June 12th. We should see, and it's year over year. So last year's data, when March comes out, it's February data. So February of last year falls off and February of this year comes on. So we need to see improvement. But you can feel inflation just in going out to eat. Like, I went out to eat with my husband. We went to Ancho's. I don't know, we'd go to Ancho's and get 2 margaritas and it was like $60, $70. I got one carne asada taco just by itself, and he got a burrito, and we had 2 margaritas. It cost me $120. I make decent money. I don't understand, like, I'm not gonna go out to eat again. I love Ancho's, their tortillas are great, but I'm not going back there. I'm not gonna spend $120 for my husband and I. We go to the grocery store and I'm like, hey, I'm in the mood for ice cream. I pick up a little bit of ice cream or this, that, and the other, and I turn around, it's $80. Like, I'm not gonna buy or want to buy snack food anymore. Now, the other thing that's really impacting and will continue to impact is that credit debt. Everybody right now, everything is costing money and no one is actually tempering the spending. We're just throwing on credit cards. So that part at what, 22 to 30% interest rate, depending on your FICO score. So these are things that will impact mortgages. We're reducing qualifications right off the gate. We're reducing people's personal budget right off the gate. So these are all things that's hurting. Okay, you guys have seen this before. It looks like a Christmas tree on your screen. Each bar is called a candlestick. It represents a business day in the market, so Monday through Friday. And you can see, so the higher up on the graph it goes for us, the better the interest rates are. If more investors are in it, the better the interest rate. The lower it goes on the graph, that means we're having a hard time. So you can see Danny and I, in like 1 week time, we lost, what would you say, the beginning of February, Danny, about 3/4 of a point we lost?
What was it, like 80 to 100 pips?
Oh, it was bad. So when these economic reports come out, or one of the voting members of the Federal Reserve tweets, quite literally, I could lose 1/4% just that day. So it's super emotional. I've studied the emotional impact and psychology around the stock market just to try to get my head around what investors are doing. So it's semi-predictable. So how can this predict or impact you and your clients? I'll show you. So this is just a $600,000 purchase price. So this is your normal run-of-the-mill, single family, first-time home buyer home at 5% down. It can swing you really quickly. It could swing $200 a month. So not only is it swinging, and this is literally in 2 weeks' time. I'm pre-qualifying somebody on this date, and then all of a sudden they think I'm crazy because I told them their interest rate went up. So I am so getting away from, don't text me to say, what are the interest rates? The interest rates are between 6.5 to 7.5 on any given day. What you should be asking your clients and trying to steer away from is talking about rate and really talking about your payment with the client. What is your budget? If someone tells me $2,500 is the budget that we're hearing all the time, my budget's $2,500, my budget's $2,500. The reason being because the average income in Riverside is about $80,000. So if you do the math, if you made $80,000, your personal budget would be about $2,500 a month. We're at $4,000 at a minimum for a budget. So let's stop talking about interest rates and gearing to the right payment for the client, getting to those right tax rates, getting to the right insurance and all of that. Danny.
I just wanted to add something. So a lot of agents develop bad habits when they're quoting a payment, and the first thing that they discuss is interest rates. And what happens is that person remembers that rate that you as a realtor quoted to them. And then we get the backlash and we start dealing with the objections, and we have to educate the client, and it takes double the work. So Laura's 100% right. Focus on their budget and their payment, and let us deal with the interest rates.
And to that end, there are 36 variables that change an individual person's interest rate. So when I send my weekend market update out, and that weekend market update out says it's like a 6.5 FHA or whatever it is, it's the scenario that I'm putting down, but every single client will be a little bit different in it, okay? Any questions around the impact or just on where we are with rates? Any questions on what to look for in the news? Because now you know. Okay.
So what are the some of the ones that you look at?
In terms of
The news and all that? Like some
yeah, that's a great question. So I'm on Yahoo Finance constantly because I'm looking at the overall health of what investors are doing. I'm constantly looking at the S&P 500. I'm looking at the QQQ. There's a stock portfolio called the Magnificent Seven that I watch all the time. The S&P 500 is what I have quite a bit of money in, and I watch that pretty realistically day in and day out. It's on my screen all the time, just kind of watching the emotions of the market. Stocks and bonds are a slinky. They go like this. When bonds go down, stocks go up, and vice versa, because it's a slinky of risk. Stocks are riskier. So what's been happening quite a bit is this slinky is going like this all the time. Because investors aren't necessarily certain what's happening. We want everything to be okay. Everybody's craving everything to be okay. But we are definitely not out of the woods. And we are spending like nobody's business right now and putting it on credit. Now, does this really matter to generating business? Interest rates in the 6.5 to 7.5% range. So if you think it matters, actually, everybody close their eyes. Keep your eyes closed. I don't want any judgment from anybody. Raise your hand if you think this matters. Okay, raise your hand if you don't think this matters. Okay, it's about mixed. So if you're truly watching your lead funnels, if you're truly learning the term prospecting, if you're watching your time, if you're diligent with staying clear and focused, these interest rates don't matter whatsoever because there's always business out there. How you talk to the clients, how you educate the clients, how you stay on top of it and explain where we're at, that matters. But people like Gabby or Jesse who are killing it in this market, they know what the interest rates are, but they're not letting that shift their frame of mind. They're looking at their lead funnels and they're putting blinders on and they're just walking down the lead funnels to what they're trying to get to. So don't let any sort of like, we only have 200 homes for sale in Riverside. Oh my God, the interest rates are going up again. Who cares? Just stay focused to what you're doing and check yourself to make sure you're actually prospecting. All right. I think that was it from me. So again, $5 Amazon gift card, let me know. $5 Starbucks gift card, text me your notes and what you learned, and I will send you said gift card. So thank you.